Right. Morning, everyone. Welcome back to our morning kappa. We'll have our very first retail briefing, for the year of 2026. Looking at the Hang Seng Index, the index have experienced a very strong profit taking on the eve of the New Year Day, right? On the 31st of December, the Hang Seng Index experienced a very strong selling pressure. So over the last 1 month, in the month of December, I can see that the index have quite a lackluster performance. The index has been trading below this 20 days moving average, and right now is drifting lower below the 50 days moving average. Now, overall, the momentum remains weak right now. However, the strong support should emerge at 25,000 point level. So in this month of January, I think that the boost will stage a rebound at 25,000 point. So if a bearish breakout on this 25,000 point, then the overall technical setup will tilted towards favor the downside risk. Right. So at this juncture, we still keep a bullish bias with the stop loss point at 25,000 point. And looking at the last 1 month performance, so we change our settings to price volume in the 1 month and also price performance of the 1 month. Then we can see that for the past 1 month, the Hong Kong market generally experienced profit taking with the biggest casualties seen in the Tencent went down by 2%, Xiaomi 4.7%, but the SMIC managed to rebound with 3.7% over the month, right? Just look at this picture. You can see that most of the counters are in the red, right? It shows that the sentiment in the market remains cautious and the momentum remains weak. Despite that, um, the robotic counters have actually quite stand out among the peers, like the 9660 and also the 9880, which are both company in this the doing the technical building the technologies for the robotic solutions. They have actually have outperformed bucking the trend during the last 1 month, right? And so on the Wednesday, we did have discussions on the BYD, right? You can see that BYD have experienced a very long period of corrections. Initially on the Monday, it have a gap up, but the momentum did not follow through, right? It actually pulled back and right now testing at 95. So the next support level will be at 92. A break below this 92, right? Again, the BYD we undergo another fresh round of selling pressure again. Okay, so immediate today and also next week, I think these are 95 and 92 will be the support level for a technical rebound. For those of you who want to buy low on the buy on the dips, you can actually look at 95, 92 on the BYD. Then on this year, in the month of January, there will be one Fed meeting that is going to take place towards the end of the month, 28th of Jan. So far, the consensus is that the Fed is not going to cut the rate. It's going to maintain the 3.75 at this January. But we look at we move the tab from Jan, you go to the December month tab. You can see that the in the December month, this by the CME website, right? On coming to the month end of the 31st of December, right? The consensus is that the Fed rate is going to land at 3.25, which means this year 2026, markets still think that there's a downside risk on the Fed rate, right? It's not that aggressive as we've seen on the last year projections. It's going to be only a 2 cut this year, right? So generally, if the rate cut on the Fed, then the dollar will get weaker, and when the dollar get weaker, our currency like ringgit, all right, will get stronger, right? So this is something that we'll look forward to. I think this year, right, one of the things that we are looking forward is whether the ringgit can go to 4 or even we can go below 4, right? So that's something that relate to our market. And then on for this month of Jan, right, one of the key instrument that most people are talking about is also the precious metal, the gold, also with the silver, right. Last week, the CME have imposed raised the margins on the silver, gold, palladium across the metal, right, and that's what we see strong corrections happening in the market. So this year, at least there was a two round of the revisions on the margins. But on the first round of revisions of margins, the gold managed to form an interim base and it continued to move higher. And last year, 2025, right, it almost break past the 4,006 level. So right now on this 2026 first month of the year, we shall see where is the interim support. Is it 4,002, or is it going to have a deep pullback towards 4,000? Now, for our technical reading, we think that a very important support will be at 4,000. As long as it stay above 4,000, the bulls will have an advantage on the gold prices so far. Now, meanwhile, the WTI crude has been undergoing a corrections after all three consensus agency, the EIA, IEA, as well as the this OPEC, right, both having a forecast that the demand supply in the crude best case is going to be a balanced market, right. The OPEC have actually downgrade their forecast from a mild surplus, mild surplus deficit to become a balance. So as such, the crude oil basically right now is more hinges towards the geopolitical risks. So whenever there is a geopolitical risk that happened, right, I can see the crude oil went up. But after that, the rebound just couldn't sustain, and the crude oil just go on a low fashions. So you can see that I think this coming month of Jan, we'll be looking at these two instruments, the crude oil, which is going to affect the inflations in the market, and also the gold prices, which one of the theme called dollar de-dollarizations that are happening, and also whether the Chinese or the these BRIC countries are going to continue to buy on the physical gold, right? And looking at the US equities market, right, so far technical remains bullish, despite that the momentum have slowed down recently. For the past 1 month, we can see that the Tesla, Nvidia have actually outperformed together with Micron and Palantir, right? The biggest casualties was the Avago, Broadcom, right, Robinhood, Costco, and these are the companies that experience selling pressure. So Oracle has been also have went down the price compared with the month of November, right? So we shall see that coming this January, right? The US is going to give the corporate results again, right? And also markets actually looking forward what's their guidance for 2026, right? So I think that in the month of Jan, right, the US market will undergo another round of volatility again once we go into the earnings season, which I think is going to be about 2 weeks from today, right? And as for the Malaysia market, right, FKRI, we still think that Boost is still in control, right, with a stop loss point at 1630. Now, looking at the seasonal effect, right, for the past 10 years, month of Jan, sadly to say, likelihood to have a downside risk. But there's still a few years like 2024, 2018, and 2017. The index do give a positive returns, right? But I think that even in the month of Jan and also Feb, market undergo corrections. We just have to look for the good companies to buy on the dip. And I believe that when the market have formed their bottom, right, we shall see a Chinese New Year rally that's going to happen in somewhere between Feb and March. right? So this will be one of the opportunity that we should see in the first quarter of the year. One of the sector that we should really pay attention to will be the banks sector. So afterwards, David is going to share with us a bit on the bank. Before that, looking at the FCPO, right? The FCPO is undergo another round of corrections after the exporter consensus shows that on the money basis, December export have been month on month lower. Right, so at this juncture, 4,001 will be the resistance for FCPO, and we set our stop loss at a higher resistance for 180. So for the past 1 month, in the Malaysia market, the contributor on the index was like Tenaga, Maybank, CMB, right, as well as Public Bank, right. The disappointed ones was Gamuda, right, Inari that went down by 20%, and also some other non-index stocks like Zitrix, Genting Malaysia also actually went down over the month. But generally for the month of December, right, you can see that the sentiment are quite bullish on the Malaysian market, which are quite intact with what we have mentioned, that seasonality, right? December month is always a bullish month, right? And so yesterday I met with our dealer. We have spent some time together. We were talking about what are the stock that we can actually look at. One of the counter that I would think that quite interesting is actually Leong Hub, which counter has been generating quite steady free cash flow, right? As you may aware, right? In when the interest rate is going down, right? Generally, borrowing cost is cheaper, right? The funds or actually the market will actually look at the counters which actually can generating cash, right? Good cash flow company. Usually you can see their share price actually move on a higher basis, right? So I think that Leong Hub technically still look very strong to me, right? And I'll set the 69 cents as a support level, and right now it's 75 cents, and then on the upside is heading towards 78 cents. And research also give a buy call on Leong Hub. I think the target price is around at 80 cents. Okay, so we can continue to look at this stock where the bullish momentum remains intact so far. So apart from Leong Hub, we have two more trading stocks this morning. Firstly, the Dagang Next Exchange. The DNEX is breaking past 31 cents and now heading toward 34 and followed by the 36 cents. Downside support is at 29 cents. And then on we have the Hume Cement Industries, which will break past 3 ringgit and 35 cents, R1 at 3 ringgit 45, and followed by R2 3 ringgit and 55 cents. Downside support is 3 ringgit and 25 cents. So we have two breakout stock. Firstly, DNEX, secondly, Hume Industries. Okay, I'll stop here and pass the stage to David on the bank sector rep.
Okay, thanks, Joseph. Hi, morning, everyone. Happy New Year. So for today, we actually have the banking statistics numbers. This is for the month of November. In November, system loan growth moderated slightly. This was down to 5.2% year on year versus 5.4% in October 2025. Household loans continue to grow at a steady pace of about 5.4% year on year, but the slowdown was actually coming from the non-household loans segment, which slowed to 5% as compared to about 5.2% in October. Within the business segment, finance, transport and communications, utilities and real estate were the drivers, while in the household segment, loans and residential mortgages remain the main drivers. On an annualized basis, the loan growth stands at 4.8%. This is actually tracking our 4.5% to 5% estimate for 2025. Nevertheless, despite the slight moderation in loans growth, we stay positive given the loan pipeline heading to 2026. If you look at the 11 months figure or the year-to-date numbers, the non-household loan applications are up 8% year on year. Approvals are up about 6% year on year. But disbursements are actually down 9% year on year. So there's been a bit of a slow disbursement period that we have seen. So the combination where you have your approval pipeline building up, coupled with a delay in disbursements, This suggests that there should be a catch up down the road, either in December and potentially spilling into 2026. But either way, again, loan growth should pick up, and that's why one of the reasons why we stay positive on the banks. For the household segment, the year-to-date application approvals are up about 1 to 2%. So that suggests how the household loan growth ahead is quite stable. Deposit side, this continues to remain a bit of a laggard. This was growing at 2.7% year on year versus about 4% in October. And with that, the system LDR is now at about 90% versus about 88% a year ago. Nevertheless, the system liquidity coverage ratio is still at about 146%, quite comfortable and well above the 100% floor. And hence, I think that banks should have no problem funding their loan demand ahead without turning too aggressive in terms of competing for deposits. Asset quality, just a very marginal uptick, but it seems to be quite stable. We do note that the loan loss coverage ratio continues to trend slightly lower, and that suggests that banks are comfortable with asset quality and are reversing some of these buffers to help with bottom line growth. So overall, we are still overweight on the sector, despite the slight moderation in year-on-year loans and deposit growth. The system loan growth is tracking well our estimates, and the robust non-household loan pipeline should be positive for overall loan growth ahead. Top picks are CIMB, Hong Leong, as well as Public, and we also have buy calls for Maybank as well as MBSB. Okay, that's all from me today. Thank you for joining us. Happy trading, and see you again on Monday 8 a.m. in the RHB Morning Kappa at 8. Thank you.